Hey everyone, and welcome to the Bricks, Bucks, and Bytes podcast, your weekly dive into funding, market, and investor news in architecture, engineering, construction, and supply chain. Before we get started though, if you're a startup founder or operator responsible for innovation in your company, or you want a deeper, more insightful look into technology in AEC, you won't want to miss our newsletter. From deep dives into particular technologies such as AI, robotics, design, software, and so on. Hot takes from investors betting big in AEC technology and advice on building tech companies, including the stories and takeaways of the most successful AEC technology founders. Head over to www.bricks-bytes.com and sign up today to get this exclusive material straight to your inbox. And now for the episode.
Hello, Patrick. Good morning.
Morning, sir. How's it going? Safely back, huh?
Yeah, safely back. Yes, I had a very enlightening trip to QB's factory in Eastern Europe, and it was great. We'll chat about this a little bit. How are you?
I'm doing great. I am currently enjoying a little bit too many deals that I like. That's keeping us here busy, myself included. But that obviously is a good time. And
Very
best.
Very good. Too many deals that you enjoying means that you've not committed, but you would like to be committed.
Potentially in the advanced stages of processes here.
Okay.
across different regions, and that hasn't happened in a long time because our bar is over the years. It's changing, and then doesn't happen that often anymore that we have multiple ones at the same time that we get excited about. So that is, I feel energy. It's good.
Great. So just briefly on this subject, what is the reason for these deals popping out suddenly? Is there something changing in terms of more macro startup kind of environment, or it's just coincidence?
There is no structural reason to it, because so sometimes when there are people who like to go to demo days, and then all of a sudden at a demo day they see 350 startups. So that's like a big bus arriving, and now everybody gets out of the bus. We don't have that, and it's also not the effect that currently hits me. It's completely outside of control, if you want to call that luck. It's just that high quality companies, for reasons outside of our control and no structural reasons in the market, are coming to the market at the same time, and they fit our taste. Hopefully we fit their taste too.
All pre-seed, right?
Seed rounds, pre-seed rounds, one late seed round, if you want to call it that. So all in our sweet spot.
Geographies?
USA, Europe, Asia. We have recently done two. One was announced, the other one was not announced. So I think Asia, maybe next month again.
Which verticals?
You're really investigative this morning. Construction robotics, construction software, and a mix of construction hardware and software for contractors. I'll leave it at that high level.
Yeah, I don't want to be too pushy.
No.
Okay, and congrats on the recent funding. You guys were leading the what's the company name? Remind me. They are doing Windows. Yeah, they are doing the windows and doors. Yeah.
Thank you for that, Martin, but you know me long enough now. So this is actually accidental, because we, out of principle, unless the founders completely insist, which rarely happens, we do not announce our first checks. Because for us, it's about, hey, the company should have something to announce when there is, when the announcement can be made around the substance of the company, revenue, partnerships, very clear product or customer expansion, but not about funding. And unfortunately, though, India has such a great journalistic ecosystem around technology and VC, very different from the US, by the way, that find very sneaky and hidden ways in order to always get informed about when an equity financing has happened. It also has to do with the fact that in India, there's a corporate registry similar to the UK and to Germany. So these guys have a good way. So this was actually an unintentional announcement that we didn't control. We wouldn't have announced it. The founders wouldn't have announced it, but the journalists actually found it out, and then we had to comment on it. But yes, this is the deal that Shub did. It's in the cloud manufacturing space for the building envelope, starting with windows, doors, and the framing for it. Quite happy with that. Very strong.
Good, congrats. We'll get Shub to disclose more soon.
Yes.
Okay, so today we'll have two subjects. First one is BuildOps rising 127 and becoming unicorn. We'll see about that. And another one is QB. Maybe you'll discuss a little bit about offsite manufacturing and mobile microfactories, and we can share some thoughts on that. So onto BuildOps. So BuildOps raises 127 million in Series C funding and achieves unicorn status. So Patrick, can you tell us what is BuildOps, what product they have, where are they on the journey, from what you know?
Absolutely happy to. And for context, I'm not an investor. So BuildOps, many of our listeners and viewers might remember Service Titan from the recent IPO. So let me actually start with Service Titan because BuildOps is having some similarities here. So Service Titan is a company that over the last 10 plus years has developed a suite of software modules for commercial contractors, for tradespeople in the HVAC, plumbing, electrical, mechanical trades, landscaping, all of the trades that shape the atoms around us every day, and oftentimes organized in small companies, medium-sized companies, etc. And so Service Titan has built this suite of modular software that covers all the different workflows that you might have as such a contractor. For example, the workflows quote to cash, right? So I'm quoting my customer, I'm granting them an invoice, I'm collecting the cash, but also the field processes. So how do I, for example, assign tickets to my field workers? How do I remotely quality assure that? How do I capture notes on the executed work, etc.? So Service Titan has basically worked itself through two different axes. One is the depth of workflows for the contractors, and the other one is the number of trades of contractors that they have added over time. And that has led Service Titan to IPO in the last few months. At several hundred million of ARR. BuildOps, when you look at it, is very, very similar. I would say that several of the contractors in the electrical, plumbing, HVAC ecosystem would actually make a purchasing choice between buying Service Titan or buying BuildOps.
So these are direct competitors?
In some of the trades, I would say yes. Certainly, if you talk to the founders, I'm very certain they will be able to tell us differentiation. I'm very certain they can tell us, hey, this is why customers choose me, and maybe the other company would be able to say, hey, this is why my customers choose me. I'm very certain there is some differentiation that goes beyond the surface level, which I'm not privy to. However, when you let's say map it on a slightly higher level. Yeah, I think they are attacking pretty much exactly the same space, and buyers have choice between the two.
Side question, is Build Vision in the picture of what they do as well? Or not really?
Now you have to tell me why you're asking that.
Because there is, going through BuildOps website, there is lots of plumbing, electrical equipment, and the premise of Build Vision was to, let me see if I can get it right, to help purchase the best mechanical equipment in the cheapest, I guess, most efficient way,
Yes.
for GCs, right? So that's just a little bit similarity that occurs to me, but I might be.
So you'll have to ask Mike, and I think you had Mike on the podcast recently, is that right?
Yes.
Yeah. So we'd have to ask Mike directly, and it's not something that would have come immediately to my mind. Perhaps there is a long-term convergence going on, but the way I've always understood Mike and Build Vision is that their core premise is to actually, when a contractor generates the RFQ, they include the material sourcing. That under the premise, for example, that eventually the materials prices, the availability plays a major factor into how you would actually price your RFQ. And so that's something they connect. And I have never heard of BuildOps or Service Titan doing that.
Okay. All right. So we've got 127 million of Series C. So the founders started the business in 2018. So this has been going on for 7 years.
Right. Older than fundamental, unfortunately.
Older fundamental. Oh, would you be an investor?
No. I mean, the company existed before we started fundamentals. So that's, you can't be early enough for everything. But I'm friends with some of the investors, for example, the Schneider Electric crew. Congratulations to them, as well as the next 47 guys. So I think this is a terrific win for them.
Okay. Do we know if the solution is like what do they need this money for? 127 million, I guess, at this stage is to scale the operations which are already showing some sign of potential of profitability. Would that be correct?
Hey listeners, I want to take a quick break to remind you about the Bricks and Bytes newsletter. If you're interested in learning about the technology shaping the future of construction, you won't want to miss the valuable insights we share each week. To get this exclusive content delivered straight to your inbox, head over to www.bricks-bytes.com and sign up today. Link is in the show notes. Back to the show.
Potentially, but I would be surprised. This company operates in the United States. It's not ruled out, but it would be very rare for a company at this stage to demonstrate net profitability, even before taxes. So that is something that for me, I was referring to the cash flow basis, not the P&L basis. So that's not something I would expect a company to show at that stage. I've just researched some numbers that you can find online. These are to be taken with a grain of salt, but someone had published, some external pundit had published numbers that BuildOps was at 52 million ARR in 2024. So if this is a unicorn valuation, and if this person that published those numbers is correct, that would imply a 20x on the previous ARR. So not even a forward multiple. So that would then be actually quite well priced if that number reported was correct, even if the company is not net profitable. So it might have been, actually based on value on the substance of the company in terms of the revenue. To me, that would sound like a very reasonable price, actually.
Okay, by well priced, hearing it from a venture capitalist means that cheaply priced or well, reasonably priced. What would I?
Yeah, that is not an adjective I would use in the context of venture ever, because there's always risk involved, and in the end, truly you only know if you paid well once you have returned your money. If you're still involved and there's still risk involved, then it's really hard to call anything cheap, but also expensive, because sometimes what seems expensive later on when you return your money 100 times, it might again seem cheap in hindsight. So these are not two adjectives that I would use while you are still along the way. Reasonably, in the sense of benchmarks, how other companies with that kind of revenue might also be priced.
Okay, I'll go back to the total funding and valuation.
Again, Martin, I just want to call it out. So this is an external pundit that doesn't have anything to do.
Yeah.
I just did a desk research. It might not actually be the real number.
Cool. Okay. We'll go back to the funding and valuation in a second. But in terms of competition, you mentioned Service Titan is also in the US, and that's direct competition to them. Do you see similar need for platforms like that in Europe? Is there anyone there in the rest of the world?
That's a good question. So there's a structural market difference. So it's not for a lack of trying. I have heard pitches from founders, hey, I'm the Service Titan of Europe since we started Fundamental. And I've heard them more the last 2 to 3 years. There are two structural market differences here. So the first one is in the United States, you tend to even the smallest specialized subcontractors tend to be larger than their equivalent in Europe. So you will actually have subcontractors in the United States that dedicate to electrical that have 100, 200, 300 million of revenue, and you will have several of them. In Europe, that hardly exists. So the subcontractors that dedicate to a specific trade are typically a fraction in the size of the upper tier of American subcontractors. So there's a structural market difference here. And the second one is the European contractors have historically left behind software adoption from the United States. Now, eventually they're doing it. I also have a company in my portfolio that builds contractor SaaS for SMB contractors, and we are seeing a nice uptick there in the last 1.5 to 2 years, which has to do with an acceleration of the adoption cycle of contractors. But I would say it's probably 5 to 10 years behind the adoption experience that American contractors have in software. And there's a behavioral implication here, because you have to get used to the process of using software, learning software, changing the processes around it, the purchasing governance, how you actually evaluate purchasing software. There's capability gap involved that you have to build, and that takes a little bit of time. It's not, I can tell you by experience by now that it's not from, oh, construction is not digital or people can't use software. That's not the point. The point is you have to learn. A lot of these things, you have to then ingrain it in your purchasing governance, in the processes of your company. And that just takes time. It takes every industry time. And so because the European contractors have lagged behind the American contractors to make that all these kinds of experiences by 5 to 10 years, we're seeing this trend a little bit later. So these are two structural differences. But Service Titan was successful in its IPO, and it's a good company. BuildOps seems to be a company with a lot of substance, looking from the outside in, and the data points that we have. So there is interest from investors to actually find some way to build something similar in Europe that takes the European ingredients. And so the most likely path that we're currently seeing is actually roll-up plays, where I'm seeing multiple private equity players, as well as venture-backed larger contractor software that tries to purchase together different kinds of softwares, and that way achieve the modularity, but also achieve potentially, I'm not necessarily buying it, but there is a case to be made here, cheaper distribution and cheaper acquisition of customers. So the European way to build a Service Titan currently, many people are betting on roll-up.
Mm-hmm. So this concept of software modularity is interesting. Can you tell a little bit more about this, maybe on examples of other companies, if you know any?
Sure. So think of it like, when I'm a contractor, I have all these different processes, right? I mentioned the quote to cash workflow. I might have scheduling problem. I need to have financial monitoring of my cash and margins. I need to perhaps manage inventory if I'm a little bit in larger projects, or maybe I have equipment that I need to monitor the inventory for. So there's a bunch of workflows involved when I'm even a specialized contractor, when I'm a contractor. And so these workflows, I can choose to do them with pen and paper, with spreadsheets. The worst solution that I absolutely do not want to do as a contractor is to have 5 different specialized softwares for each of these workflows. Contractors don't want that. So
Procore is a kind of modular.
Very similar. It's a very similar starting point. Exactly, right? Obviously, Procore is started further downfield, and with larger projects, whereas Service Titan and BuildOps have started a little bit more back office traditionally, and with a little bit smaller and more specialized contractors. But the premise is exactly the same, Martin. Thanks for pointing that out, is that I can actually add modules to the software to cover all the other workflows that maybe I'm not covering. So that eventually the purchasing choice or the substitute is not, hey, I take BuildOps or I take 5 softwares. Nobody would ever do that. The purchasing choice is, I take BuildOps or I take spreadsheets. Because nobody wants 5 softwares for 5 different workflows among the contractors. And so that's very appealing when you can build something modular that way.
Great. Okay. So so we've got Service Titan, which is the Titan, first one. That I just reading through Wikipedia page, and started 2007, cloud-based platform launched in 2012, IPO in 2022, current revenue 600 million, net income 195.
That's correct. Service Titan IPO the last few months.
Oh, was planning initial public offering, 2022, and maybe...
Yeah, it was planning.
Okay.
It delayed, and then they did an internal pre-IPO round with an IRR to IPO deal, which was very expensive for them, and then they IPO'd. I want to say 2 or 3 months ago.
Okay, so I wanted to cap in the light of Service Titan, and as you as a venture capital guy looks into the space and looks into software like BuildOps, what are you looking at in the potential investment, having in mind that there is this Service Titan, literally, who is in the space as a incumbent, actually, right? And competing software of BuildOps, trying to compete with a Titan. What do you see there? What's the advantage of BuildOps?
Great question. And now you're luring me a little bit to reveal our taste, but also how setup of a venture capital firm plays a role in how you evaluate this. So I need to, Martin, is it okay if I give you a slightly more contextualized, longer answer?
Of course, yeah.
Okay. So in the United States, so people don't realize this because there's so much marketing and propaganda in VC. The US VC market is the worst performing of all VC markets across the world in terms of the financial performance of the VC asset class. So it's hardest to actually return money for VC investing in the US than anywhere else. Fact. Do your research if you don't believe me. That's a fact. Now that doesn't mean that the top performing VC funds in the US don't make money. They do. Mm-hmm. And the highest outliers also typically get produced in the United States. That's very appealing for VC because we're a power law industry. And in the end, we're all betting on the very, very, very highest Airbnb IPO for 80 billion at the time. You don't capture 80 billion IPOs unless China in the 2000 to 2014 timeframe. That's where similar things happen. I think it will happen in India, and Europe at some point will produce something like that too. But then the US might produce the next $1 trillion IPO. So the highest peaks will happen there. But as an industry, as a geography, it produces the worst VC performances across all geographies. Mm-hmm. That's a fact.
On the average,
that has them
on average
across every vintage year.
Yeah.
So, let me retrace that. Not every vintage year, but across almost all vintage years. Mm-hmm. There's an implication here. So a company like BuildOps is in a competitive space where you already, when the company was founded, there was a 6-year-old Service Titan in that industry. So there was someone that had already built something. Now, the US VC market is full of venture capital dry powder. Dry powder means how much capital has been allocated and is ready for investment, is managed by VC managers, and can be invested. The problem is when you have a lot of money, in VC, you cannot have a lot of companies that have the promise to go super, super high. And the equity that you can purchase in the very best companies is limited. There's only 100% ownership in every great company. You cannot buy 110% unless you're getting into whatever, naked shares. We're not doing that in private. So that means that the ownership that is available to purchase for the capital that is available in the very best companies is always limited. So when I now allocate a lot of capital to the US market, to the US VC market, that capital seeks equity. And it looks at equity in a way, hey, perhaps this could be another one that goes really, really big. So here comes now my perspective and why setup of a VC fund matters. So because the US market produces worse financial performance in VC than the other markets, you have to have very large funds in order to, as a fund manager, live with the risk of underperformance. Why? Because the management fees will still make you whole. You can still kind of live from that, and you're not necessarily having to do with the carried performance. Or if you're a smaller fund, you have to find the assets that actually will end up being the winners. Now, a market in which there's already a likely winner, and then backing a company against that at the seed stage, that's not necessarily the taste of fund managers that manage 50, 100, or even 150 million. but instead they will typically look for something that is less obvious, for something that is initially less competitive, for something that has more time window to build out category leadership, etc. Which means that in companies like BuildOps at the seed round, you will typically see very large funds at the beginning of the rounds, and it doesn't make necessarily the taste of the smaller funds within the US market, because the big funds need the very big swings to kind of work, and they try to find them even in categories that have been explored and defined before. So the category clones are actually appealing to you. In BuildOps' case, it looks to me like that worked out because the company does seem to have a lot of substance, but it's not necessarily a good bet to make at seed for a small fund.
Interesting. So you said something that caught my attention is it's not compelling for a fund to invest in a seed round where there is an obvious incumbent, let's say, right? You said something like that. So what about design kind of related software competing with Autodesk, for example? And I know you've invested in a few. So there is another probably non-obvious component within these that made you invest, yeah? Because this is exact example, right? Like Autodesk is one of the leaders, and then you've got in your portfolio Speckle, for example, right?
For example, yeah. And others, Step True, Rayon as well. So the way I define, so when I speak of hidden in spite of obvious as my taste, I always refer to something that is obvious to the buyers, the customers, and they are buy ready for that obvious reason. But that obvious reason is hidden or non-obvious to generic founders, to people from other industries, generic investors, up until a certain point in time. Eventually, substance always becomes obvious, but the longer I can keep it hidden, the longer my option value to keep building and compounding and building out more optionality around. And that's good. So now in the context of your question, non-obvious doesn't mean that you're hidden to everyone. That market just doesn't exist, because if you're hidden to your customers, then you actually don't have a market. You're then waiting on a market to develop in a couple of years. So that's not the definition of non-obvious that I'm using, because that wouldn't work. You need to be non-obvious, in my taste, to other generic investors or other generic founders for a while. And so in the context of Autodesk, that means I'm not concerned with the incumbent. I'm concerned with 10 different category clones that try to do the same that I'm doing, going after the incumbent opportunity, right? And by the way, Autodesk is a terrific company. I mean, that's not easy to compete with, and they might very well win this race. Great market. It's a fantastic business for more than 40 years, right? And so I don't want then on top of that, though, 10 other category clones. Yeah. So that means in the context of design tools, what is non-obvious here sometimes is the bet on open source. Sometimes it's the bet on the community. Sometimes it is that you have to build very high minimum feature sets to actually build that product. And that is not necessarily appealing to a lot of other generic founders, because they might want to go with something that they can build quicker, that they can understand more quickly. The amount of understanding that you need to build a new authoring tool is very, very high. Just ask Altaf. I mean, something, I think so. That's a little bit different, whereas the opportunity that BuildOps and Service Titan are going after has been a little bit more obvious at the early inception, although it was still contrarian in my mind, because people will have told these companies, oh my God, construction tech, is that even a category? You sure you want to build for HVAC and plumbers? I've never heard a great company being built for plumbers. I can guarantee you, Martin, this is some shit that they heard at the time when they were founded, but now it's obvious. Nevertheless, when BuildOps founded, there was already someone else doing it, and it had become obvious by the time. But when Service Titan started, it was completely non-obvious in my opinion.
Yeah, that's how it works. Yeah? Okay, well, last thing I wanted to touch on regarding BuildOps, maybe there will be more, but let's see. So they secured 227 million in Series C funding. This brings the total funding to 225.8 million at the valuation of 1 billion, making its entry to the exclusive unicorn club. And looking from the outside in, This doesn't sound like a unicorn when you put 1/4 of the valuation into the company. But like, why am I thinking about it in the wrong way?
So look, the outside is
Look, just like a little bit of not background, but a little bit of but as far as I know, like traditional businesses are valued between, it's not a traditional business, but I'm just giving by comparison, between 3 to 6x of a revenue. I know that 2 to 5 million is not a revenue, but it feels like someone has put 225 million into this business and the valuation is at 1 billion right now, whereas normal traditional business has revenue and it is valued at 3 to 6x. In construction, for example, in the design space that I am at. So yeah, tell me what I'm thinking. How am I thinking wrong about it?
Let me move you away completely from technology for a minute, because I think the principles underlying the valuation are even easier explained with an industry that we all understand. Do you know, Martin? It's not a trick question. Do you know what is the biggest business of Warren Buffett's Berkshire Hathaway? What is the biggest business that drives most of their EBITDA?
Insurance?
That is exactly right. It's insurance. That's the core of Berkshire Hathaway. Why? You can, sorry, that was a rhetoric question. Let me tell you, Martin. So I read every yearly management letter from Warren Buffett. You can read them back to the 1990 or so. They're all online. So if you're interested, just read them. And he has a fantastic writing style. It's really entertaining, but also insightful. And so in the latest one, he had elaborated also again on the core business of the property insurance, or sorry, property casualty insurance, I think is what he wrote about. And the way he thinks about the insurance business of Berkshire Hathaway is in terms of the acquisition costs and then the cash flow. So the acquisition costs are, for the next renewal of an insurance, fairly low, because the customer would renew the contract exactly on a yearly basis. So really what you have to do is exchange 2 emails. Over exaggerating, but you get my point, right? And I don't necessarily have to drive out again to the customer, inspect the property like I have to do perhaps at the very first sale, right? So the renewal is great from a customer acquisition perspective for the insurance carrier. And the second thing is it's prepaid, while the actual cost of delivering the insurance only ever happens in the case of a casualty. And that casualty might be 30 years down the line. That's actually not very good, because that means you have to run some financial models and you have to have the balance sheet to do that. But let's take car insurance. In the car insurance case, that damage might lie only a year down the line. So that's much more controllable. Yeah. But it happens a year after you have collected the cash from the customer. Isn't that a great business, Martin? That's fantastic. Because the renewal of the insurance happens at almost zero incremental cost, and I collect the cash up front. Someone is giving me cash that I can now do other things with. A portion of that I set aside for some potential casualty in a year from now. Other contracts have zero costs because there are no casualties, and the remainder of the cash I can do other things with. Brilliant, right? So now moving that logic back into the
I'm dying to see how you connected.
Yeah. So back into the technology space, when you're a traditional services business like yours, you have to acquire your customers for every new project, right? And so over time, it does get simpler because you have track record, it compounded, and your customers kept coming back to you, right? So they are basically saying, hey, Martin, you did a fantastic job. Can you please also do that for me? At some point, your order books are full. You don't have capacity because all of your existing customers are only wanting to work with you, and you don't even do any new acquisition until you say, hey, you know what, my order books are full, let me hire someone else, or maybe I find other ways to streamline my operations, become more efficient, and then you have bandwidth again, and then you're doing new customer acquisition. But overall, your acquisition costs have become simpler than 5 years ago. I imagine that is the case. But one thing that you do not have is automatic renewal, right? So when you now go to your bank will say, hey, Martin, but can you really guarantee me that the revenue next year is going to be the same as this year? Warren Buffett can. because in his insurance business, he has statistical probabilities plus the business logic that customers will review to the percentage that he can prove. In your business, that's unprovable, right? Because here it could be depending on the general economic status. Maybe next year there's a down year, there's a recession, and your customers might purchase 30% less. It's hard for you to anticipate all that, right? And so that's why the bank would tell you, well, let's be a little bit more careful here. I know you have a great track record, etc. So that's one. And then two is your customers, in your case, maybe even they pay you a little bit upfront. They certainly don't pay you 100% upfront. And then the cost to deliver against that also happens fairly immediately. So these are reasons why your business should receive a smaller or a lower revenue multiple than Warren Buffett's insurance business. Now, a SaaS business, a software as a service business, has a similar allure to investors because you make the sale once. There should be very high renewals. So in a business like BuildOps, if you have we call it net dollar retention, a net dollar retention of 130% or more, which means that not only do your customers not churn out, they actually purchase more from you compared to the very first time they signed a contract. In a business like that, that makes renewals and thus the customer acquisition cost of the next incremental euro of or dollar of revenue so much lower, right? Even negative if you do it the right way. And you can actually have in SaaS upfront paid contracts to the same way that you have the insurance. So that's the reason why a business like a SaaS business like BuildOps can sometimes be valued substantially higher at, for example, 20x ARR in the public markets if you're a fantastic SaaS business. And that would be valued differently from the traditional business reference that you were making.
Yeah, no, that's a great explanation. Thanks. But the thing is that the level of valuation and level of funding, right? If there is 4x difference here, let's say, and the annual recurring revenue was 20 million, something like this.
And I mean, this external pundit said 52 million in 2024. But again, I don't know if he's correct.
Okay, so it's still 4x less than the funding level. So what is very interesting is at what point this all starts making sense. The valuation versus the amount of funding, and they at some point need to start bringing this cash, right, into reality in terms of
it's relevant market. So I can
inflection point is required here. At what's the inflection point and when? That's
okay. So you're now getting very much into business fundamentals and my view on that. But what I've realized over the years is you can invest in two things when you invest in a business. You can actually invest in the business of the business, or you can invest in the share price of the business. And they are two different things. If the product you're investing is the share price, you're really betting on someone else buying the shares at a higher price later. Bitcoin is exactly that, right? Bitcoin, I mean, it doesn't have any fundamental utility. There is no fundamental product to this. If I'm storing my value in it, the product is that someone else will buy it for a larger price later. And there are reasons why that happens, right? Demand, supply, blah, blah. You know this better than me. I'm just pointing out that I can only invest sometimes also in the share being the product and that someone will purchase that for a higher. Or I can invest in the fundamental business of that, which is what Buffett, for example, I think is doing since ever. And here the business is the product, the cash flows, the margins of the business. And so for me, when I hear your question, when does it all make sense? Honestly, the answer always is when the company is cash flow positive and growing at a healthy rate, becoming even more cash flow positive. That's when it all starts making sense.
Here is the reality of startups, the world. Yeah.
Right. Look, I mean, Infomarket makes more than 100 billion in net profit last year, plus in cash flow generation. So it is possible. It's not impossible.
It is not, yeah. Okay, great. I don't think we have much time to touch on the QB, but maybe we'll do it next week or sometime in the future. Yeah. Anything else on the BuildOps that we haven't touched on and you think is relevant?
I mean, I think investors are very proud to be in this business. It looks to me like something that, first of all, it's the next contact unicorn. So that's great. That makes it, I think, currently number 17. I'll update my list. helps all of us because it gives more and more credibility to our sector. And I have a feeling it's only the beginning of a wave of new unicorns over the next 3 to 4 years in contact. So congratulations to anyone involved. Congratulations to Schneider and Next 47, two good friends of ours. So I think it's fantastic. For us, it just wouldn't have, first of all, we weren't around when BuildOps was around. So anyway,
You are
from a timing perspective, it didn't, well, I mean, I can't change history, right? I can't make founded in 2017 to capture BuildOps at 2018, but I would have loved to, obviously now in hindsight. However, it would have not fit our taste. Even if we had been around at the time, it would have been a too obvious space for our taste and for our fund setup. And that's what I was referring to later. And that's why you don't find a lot of small funds on the cap table here.
So unicorn status is one thing, but like one of the pushbacks, I'm alluding now to this sentence you said that it gives credibility to our industry and might attract other people interested in the space. So unicorn status is one thing, but one of the pushbacks I've heard from one of the investors in the Middle East was that there's no public markets of construction tech companies. There's very little.
Changing, no?
Sorry?
That's changing, no?
Yeah, there's very little IPOs. That's why general investors are not interested. But
yeah, I already told you on another episode that I thought that guy telling you that is pretty much a buffoon.
Okay, and let's leave it.
Always behind the curve.
Yeah. Okay, Patrick, thank you very much for that and for this business masterclass. And see you next week.
Thank you, Martin. See you next week.
Thank you.